Hi there. I wanted to check in with everyone to do a brief little tutorial on the time value of money. So I think the confusion is probably not because people don't understand that when they have money in a savings account, it does indeed earn interest. I think that the questions might be confusing. There's different ways to think about the time value of money as it applies to savings that's being earned. If we're thinking about the future value of money, we're basically saying that for money that's sitting in a bank account or money that we're adding to a bank account, how much money will I have in a certain number of years given a certain interest rate? That's the general concept. But I understand that the questions are complicated. So I wanted to go over the most basic question that we have. Well, it's not the most basic, but it's the question that we have in our discussion forum about making what are called annuity deposits. So, or annuity being the idea that it's a fixed sum of money that's occurring annually, whether you're depositing it or receiving it annually. How much will you have after a certain amount of years? So, the question in the discussion forum is saying if we have $1,000 that we're investing every single year at the beginning of the year, or at the end of the year, sorry, because our annuity tables are at the end of the year, and that money is sitting in the bank account earning 5% interest, how much money will we have in 20 years? If we kind of do some rough math, we see that the $1,000 we're depositing at the end of every year times 20 years is going to give us $20,000, which is going to be less than what the number we're actually looking for, because we're accruing interest on that money every year. So in the first year, we're earning $50 of interest. If we look at, there's a couple ways of solving these problems. You can use a calculator, a financial calculator. You can find these online. So, for example, I looked one up 20 years, 5% interest. We don't have anything in there right now. I get $33,000. The negative there is just an accounting construct, basically saying if 20 years are going forward and 5% is adding to the account and we're adding $1,000, then sort of the opposite of what that is, the accounting construct would be a negative number. But don't let that throw you off too much. You can see that the sum of the periodic payments is 20,000 and the interest is 13,000. It's just an accounting construct. So we see the same thing if we do this in Excel. So we can, in my Excel, I'm using Mac. It'll give me instructions for future value and even provide an example to help walk me through how to do the math, or how to do the formula. So it says enter your interest rate, enter the time period, the number of years, enter the amount that you're the present value. So what you are adding in each year. So here we go. So periodic rate, number of periods, the payment. The present value is actually, there's nothing in the account right now, but we will be adding 1,000 at the end of the year. And then it's giving me the option to specify if the payment occurs at the beginning or the end of the period. The reason for this is that if the payment occurs at the beginning of the period, then we're going to accrue interest all year. But if the payment occurs at the end of the period, we're not going to accrue any interest that first year. So I chose end because your annuity table in the appendix to your text is an end annuity table. That annuity table. So your text talks about the time value of money, and then it tells you to go look at these appendixes, A, B, C, D, and E. A is future value, B is future value of annuities, present value of annuities, and then I forget what the last one is. Let's see. Oh, the last one is how to use a financial calculator. So that's basically what we're doing here. We're using an online financial calculator. Okay, so let's go back to our Excel file. So again, we get that sort of negative there that might throw you off, but just remember, it has to do with the directions of the flows. So those flows are now there. You could put in all negatives and then this number would be positive, but it's not really crucial unless there are payments coming in and out. Like if you had an amount of money that you were drawing down on, what would be the future value? And you might want to change these numbers around. But for our purposes, $1,000 going in the account, there's nothing there right now for 20 years at 5%. So we'll have $33,065. The annuity factor table says if we have $1,000 that we're making payments, our factor is going to be 33.066. I find this by looking at the future value of annuity factor table. So 20 years at 5% is going to give me this 33.066 for my factor. When you're using the factor table, you're just taking the amount invested, which is 1,000, and multiplying it by the future value factor. So the first way is the website. Use the online calculator. The second way is to use the, is to use the future value of annuity tables. So this is actually two future value annuity tables. And then let's see. I have this note in here to help you kind of understand that we basically are doing a summation, and we'd have to do this 20 times, and we can do that in Excel. So our Excel is really our third way, and I've sort of kind of laid out my thought process. So, you know, in the first year we have 5% interest times the $1,000 deposit. We have to take that year one total and then add it to whatever our deposit is for year two times another year of interest. That's what we're going to be doing in an Excel file. So I pulled up the Excel file. Actually, we already went over the annuity table, so we don't need to talk about it again. So the third way is with Excel. Okay, here's our calculation. This is our simple calculation in Excel, but I broke it down for you too. So every year we're depositing $1,000 into the savings account and we're earning 5% interest. The total amount of those deposits is $20,000. In the first year, because this is an end annuity table in which no interest is earned on that first year, we just have $1,000. So that's our closing balance. In the second year, we're going to earn interest on what we deposited last year of $50, plus we're adding another $1,000. So we add this all together and we get our closing balance of $20.50. Again, $20.50 times 5%. We're going to add our payment of $1,000 in, and so forth and so on. You can kind of see, if you want to take a look at, you know, what I'm doing here. I'm calculating interest, and then I'm just adding the closing balance. Then I'm calculating interest, and I'm pulling this opening balance from the previous year's closing balance. So all of the interest that we earn is going to be about, let's see. So we're earning $13,066 in interest. If we look at the amount of deposits we made, $20,000, and add to that the $13,000 in interest, that's how we arrive at our $33,066. But also we're getting it here, and I mean, I guess I shouldn't do that because maybe it's confusing, but our closing balance at the end of year 20 is that $33,060, and I'm pulling that down. So I'm not summing these, I'm just pulling a closing balance over from an opening balance, or I'm summing these. So that I know this might feel really confusing. There's probably only going to be one or two questions on any exams that you see concerning future value or time value of money. Present value, I don't have any questions in the discussion forums this week, but there may be some complicated quiz questions. If you run into those and you have any questions, please reach out to me and I am free to help you out. So I hope this information will help sort of jumpstart you on your discussion forum this week. I know there's some good answers that I'm seeing posted here, and I wish you all a great week. And enjoy this little mathematical exercise.